If you've spent any time in the investing world, chances are you've come across the name iShares. It's a lineup of ETFs by the provider Blackrock. As the world's largest asset manager, Blackrock know a thing or two about creating some great funds for investors. For any regular viewers, you may note that I recently covered 3 of my favourite Vanguard ETFs, and I thought today I'll provide my 3 favourite iShares ETFs. For anyone new to investing, think of an ETF as a basket of assets. Instead of buying one share in a single company, you're spreading your investment over hundreds or even thousands of companies, helping reduce risk. Today, we're looking at what I believe to be 3 of the best iShares ETFs to buy and hold for the long term. I'll mainly be looking at ETFs for UK investors, but I will include the US equivalents if you do happen to be watching from the US. First up, we have the iShares Core MSCI World ETF, with the ticker symbol SWDA. This ETF provides global exposure by tracking the MSCI World Index. It's a solid choice for those looking for diversification across all developed markets. It provides exposure to over 1,400 companies within this one ETF, making it extremely easy to diversify your investments at the click of one button. You can see here the exposure across the world. It does have quite heavy focus on the US market, but this is due to the immense amount of growth the US market has had over the last 20 years. The other markets take up much smaller holdings, as you can see. Through this ETF, you're investing in top companies from around the world, including household names such as Apple, Microsoft and Amazon. These represent some of the most innovative and influential corporations, and adding exposure to them can bring long-term growth potential into your portfolio. This ETF provides a diversified sector breakdown with a strong focus on technology, which currently represents around 25% of the fund. This is then followed by financials and healthcares at approximately 15 and 11%. This spread means you're not overly reliant on one single sector, offering balance and stability over time while still benefiting from the tech-driven growth that drives global markets at present. Now, some viewers might be wondering if this ETF has a dividend, and the answer is no to that. Instead, this reinvests those dividends back into the fund. This will help with long-term growth, and it also allows for a bit of a hands-off approach. Now, with any ETF, there's obviously fees to pay, and this ETF boasts of a low expense ratio of 0.2%, making it really cost-effective. So for every £10,000 you have invested, you'll pay around £20 in annual fees. Now that we've covered some of the basics, why don't we look at some of the past performance of this particular ETF? Historically, this ETF has delivered an average annual return of around 10% over the past decade, reflecting the stable and diversified growth of the companies it covers. If you'd invested a lump sum of £10,000 within this fund 10 years ago, without adding anything else, now you'd have around £26,000, which is really impressive growth. Now, for US investors, the closest I could find was URTH, which is listed on the New York Stock Exchange. Now that we've covered a broad all-world ETF, why don't we bring things a little bit closer to home and look at an ETF which specialises in the UK market. Next up, we have the iShares Core FTSE 100 ETF, with the ticker symbol ISF. This ETF is a great option for those looking for exposure to the top 100 companies within the UK. Now, I know what you're thinking, the UK market isn't exactly the investor's utopia at the moment, but it's a lot less restricted than you might think. Despite being listed on the London Stock Exchange, a lot of the companies within this have global exposure and operate internationally. Many of the companies operate across multiple sectors, but primarily in financials and also resources, which are typically seen to be more stable. Let's dive into what makes this ETF great for someone looking for stability and also a strong dividend. Within ISF, you'll find companies like AstraZeneca, HSBC, BP and Unilever. Major players not only within the UK, but on a global scale. The holdings in ISF are well diversified across industries, with financials and consumer staples carrying a significant portion of the portfolio. This structure provides resilience, so even if one sector underperforms, other areas may balance out the overall performance. One of the appealing aspects of this particular ETF is its dividend yield, which currently sits around 3.85%. This ETF distributes dividends quarterly, typically in March, June, September and December, making it an excellent choice for investors looking to receive consistent income. So with just dividends alone, if you had £10,000 invested, you'd typically receive around £385 per year, or £96 per quarter. Now on to fees, this ETF has a low expense ratio of 0.07%, meaning that for every £10,000 you have invested, your annual fees would be just £7. Over the past decade, it has averaged a reasonable annual return of around 6 to 7%, reflective of the UK's stable, mature market. It's worth noting here that the growth might not be as rapid as the US tech sector, but that's not what I'd be using this ETF for. I'd be adding this ETF to your portfolio to bring stability, but also passive income. Now for US investors, similar to the previous ETF, this one's not available to you as it operates on the London Stock Exchange. The closest and most comparable option I could find would be the iShares MSCI United Kingdom ETF with the ticker symbol EWU. It's ever so slightly different to ISF as it provides broader exposure to the UK market by including both large cap and mid cap stocks, but still a great option, so make sure you check that one out. Okay, so next up we have the iShares Core S&P 500 ETF with the ticker symbol CSP1. Now we couldn't do a video of core ETFs without covering the mighty S&P 500. The S&P 500 has a proven track record of strong returns over the long term, averaging around 10% annually since its inception in 1957. Historically, it's weathered various market cycles including recessions, economic booms, and periods of high inflation, ultimately delivering consistent growth. This resilience in historical performance is why it's one of the most popular options amongst investors. While of course there are short-term fluctuations, the steady growth of the S&P 500 is what makes it a core in any diversified portfolio. This ETF replicates the S&P 500, covering a broad range of sectors with a significant weighting towards the technology and consumer discretionary stocks, giving it strong growth orientation. Within CSP1, you'll find well-known giants such as Apple, Microsoft, Amazon and Google, plus industry leaders in finance, healthcare and energy. Where dividends are concerned, this ETF doesn't actually pay out a dividend. It's what we call an accumulation version, meaning that any dividends it would have paid out are automatically reinvested. CSP1 does also have a distributing version where you'll get paid out those dividends. The dividend rate is quite low though, at 1%, but the ticker symbol for this is GSPX. So if it's more passive income you're looking for, this may be better suited. One of this fund's standout features is its low expense ratio. With a fee of just 0.07%, you're getting the S&P 500 exposure without significantly eating into your returns. That means for every £10,000 you have invested, the annual fee is just £7. Historically, the S&P 500 has delivered really strong growth, and CSP1 has tracked closely with it. Over the past decade, it has averaged an annual return of around 13%, which has outpaced inflation and rivaled many other investments. If we then zoom out and look at the growth since this fund was created in 2010, you can see the gradual but strong growth. You can even see the slight dip from the COVID-19 pandemic, and yet it's still bounced back relatively quickly. The S&P 500 is often considered the backbone of any solid investment portfolio. This is due to its consistent long-term growth whilst being diversified across 500 US companies. CSP1 is definitely one of these set and forget investments. I wouldn't track the performance day to day. Similar to the other ETFs, it's one that I'd invest in month after month and watch that pot slowly grow over time. Now for US investors, again, you can't invest in this particular ETF, but there is a direct equivalent under the ticker symbol IVV. So there you have it. 3 strong ETFs that I believe could serve as a foundation for a long-term growth investment portfolio. Each one brings something unique to the table. SWDA for broad global diversification, ISF for UK stability and a high dividend, and CSP1 for tapping into the growth of the top US companies. Together, they offer a balanced, resilient mix that can help you grow wealth steadily over time. Now, these funds aren't built for short-term gains, and they're not a get-rich-quick scheme. They're built for people who want to buy and hold, making it really simple for those who want the hands-off approach to investing. Let me know in the comments if you're planning to add any of these ETFs into your portfolio, or if you think there's any iShares ETFs that you think I might have missed. If you've enjoyed this video, you might like my other video where I covered 3 of my favourite Vanguard ETFs. I'll leave the link for this in the description and also in a banner up here. As ever, if you found this video helpful, hit that like button and also subscribe for any future personal finance and investing content. Thanks for watching, and I'll catch you in the next one.